Joining us now is John Worth, Nareit economist and head of investor outreach. Am I saying Nareit? That is how we say it, right?
Perfect.
Yes. Okay. The National Association of Real Estate Investment Trusts, to put it another way. And indeed, it's been remarkable with the move down in yields. We have seen real estate stocks kind of go crazy here. Is that justified? Are you hearing a lot of optimism in the industry?
Yeah, absolutely. And part of our year-end outlook for 2024, and Christmas has sort of come early for us, was that with a normalization of the monetary policy cycle, we'd see REITs outperform. Historically, that's what you see. When you get to the end of the rate rising cycle, REITs are going to outperform over the next 12 months. This has actually been, we've seen quite a bit over the last 2 days, but this has actually really been going back to the beginning of November. If you go from the beginning of November through midday today, REITs are up about 22%, putting them in positive territory for the year. They're up about 12% for the year. And some of the sectors have really changed direction over the last basically 40 days plus.
And John, when you look ahead then in 2024, which are the property sectors you would expect to really keep performing? I mean, is it data center or logistics facilities, hotels?
I think there's definitely very clear trends and lots of tailwinds behind all the digital sectors. So cell phone towers, data centers, industrial and logistics properties, those have been very strong performers. One of the things we've actually seen pop over the last couple of days, if you go back to the beginning of November, offices are up 40%. Mm-hmm. So the other thing that we think is going to happen is we're going to see some of the office REITs, which are just about 5% of the market capitalization, but we're going to see the quality of their portfolios start to show through as we see analysts maybe stop painting all office with the same brush and recognize there's quality office and not such quality office. And REITs, for the most part, have the quality office.
One of the things we were talking about earlier in the show is residential mortgage rates coming down. And at what level you see the tipping point where demand really starts to loosen up? What's happening on the commercial side, right? What's happening in terms of sort of a freeze in the real estate market, and how low do rates need to go to unfreeze?
Yeah, I think that's a great question, because the freeze is both in terms of some owners having difficulty getting bank lending. Mm-hmm. REITs, luckily, do most of their lending in the unsecured markets, and so capital markets have been open for REITs. They came in at
a price, I imagine.
At higher prices, but because they came in with low leverage, mostly fixed rate debt, and a lengthy term structure, so that today the weighted average term to maturity is about 6.5 years, they've been able to be a little selective in when they go to market and when they do refinancings. But the real holdup that we've seen has been this lack of transactions. And I think that even with the Fed easing, that's going to be easing to a higher rate environment. So I do think in 2024 we'll see that commercial real estate sales market open up, and we'll see some of those prices start to reflect the reality of higher interest rates. And I think there's a good reason for public REITs to be potentially winners in that, because again, they're low leverage. They're coming in with low leverage. They have access to capital through both debt and equity, and so they can potentially be the buyers in those cases.
And John, I know one thing you've talked a lot about is also this kind of relationship between REITs and ESG investing, which maybe isn't a relationship a lot of people immediately think of. Just walk our viewers through that relationship, how you see it.
Yeah, and I think it's important to keep in mind, everything REITs do is really, going to be focused on the long term. They're long-term operators. They're long-term owners of real estate. So they need to be long-term, thoughtful stewards of that real estate. And so that involves understanding what the risks are from future regulation, as well as a desire to improve the sustainability performance of their structures. So what we've seen over time is that academics who have studied this find that when you compare REITs with sort of private real estate, you're actually going to see better sustainability performance from REITs, which is sometimes surprising to folks. When you understand the structure and the incentives of REITs, again, as long-term holders, they're not buying to flip over properties in the short term. It makes sense that they would also do well in terms of sustainability measures.
I have one more question on the outlook for next year, which is where you see the biggest risk. Because certainly the rhetoric surrounding much real estate, especially office, has been very negative this year. There's been talk about default, et cetera. Does any of that linger next year, or what else should people worry about?
Well, I think for commercial real estate generally, I think that even though the Fed announcement over the last couple of days has been welcome news, it doesn't mean if you're a high leverage owner that you're necessarily out of the woods, because rates are not going to come down to where they were. So I still think rates are going to be a risk, and there's going to be a process through which we get private real estate repriced and we get transactions moving in that market.